Hello, my name is Evan, and welcome to Economics 101, your number one source for everything economics. So the Federal Reserve made a decision. They decided to keep interest rates unchanged. I know this is not super exciting stuff we're talking about, but this one decision actually tells us a lot about where the economy is headed to next. When the Fed chooses not to act, that's still a very intentional move. So today we're breaking down three simple ideas and how they relate in the Fed's decision. So the first thing we're going to talk about is why inflation is still a problem. Second thing we're going to talk about is what's happening within our economy and the job situation. And the third thing, most important thing, global uncertainty. All right. Once you understand these things, I think my viewers will be able to understand exactly why the rates didn't move and what could happen next. Before we jump into the video, I do have a quick favor that really helps grow the channel. If you enjoy content like this, please hit the like button, share with someone who may need some better understanding, and subscribe so you don't miss out on what's coming next. I got a lot more content like this that can help people understand economics a little bit better, and subscribing, make sure you stay ahead. So let's go ahead and get into it. So let's start with the inflation part, all right? Now compared to a couple of years ago, inflation has definitely come down. But here's the key point, it hasn't gone down enough, all right? The Fed's target is around 2% inflation, right? And we're still above that. And not only that, the Fed is starting to signal that inflation is gonna stick around a lot longer than we expected. Now, why is this happening? A big reason right now is because of energy. Oil prices have been moving up again, and energy has this ripple effect across the entire economy. Think about it like this. When oil prices rise, it costs more to transport goods. Businesses raise prices to protect margins. Consumers end up paying more for everyday items. So even if inflation was cooling before, when you get hit with those rising energy costs, that can reverse the trend pretty quickly. All right. The Fed knows this. So if they were to cut interest rates right now, here's some things that possibly could happen. First, borrowing becomes cheaper. People spend more money. Demand increases, and you get prices start rising again. And that's the cycle that they've been trying to control. Okay. So from the Fed's perspective, cutting too early could undo progress. All the progress that they've made over the course of the years on trying to get inflation down, if you cut too soon, that can undo all of that. That's why they've been extremely cautious here. They'd rather keep rates a little higher, a little bit longer than risk inflation coming back stronger. All right. The next point we're going to talk about, the economy is slowing down, okay? Now, here's where things get a little complicated because at the same time, inflation is still a concern. The economy is starting to lose momentum. And we're seeing this show up in a few key areas. First, job market. Job growth is slowing down compared to where it was before. I talked about in previous videos the cuts that we had in February. Companies aren't hiring as aggressively. And in some cases, they're starting to pull back. Now, we're not in a crisis, I don't think, just yet. Well, some people are, but not everybody for the most part. But the trend is clearly shifting, okay? Second is consumer behavior. People are becoming more cautious with their spending. Higher interest rates mean credit cards are more expensive, loans cost more, mortgages are higher. So naturally, people start slowing down on their spending. And when consumers slow down, businesses feel it. All right, and when businesses start to feel it, they slow down on business investment and hiring and things like that. So you get this. What happens is you get this kind of chain reaction across the economy. Now, here's the dilemma for the Fed. Normally, if the economy slows, they would cut rates in order to boost growth. All right, but they can't do that aggressively right now because inflation hasn't fully gone away. So they can't cut rates too much, okay? So they're kind of stuck in a balancing act between two risks. All right, if they cut too soon, inflation could possibly come back. If they wait too long, the economy could weaken a little further. Okay, and when you're facing that kind of trade-off, the safest move is to pause, gather some more information, which is kind of what they're doing right now. Quick pause break, guys. If you want more breakdowns like this to help you understand economics, hit the like button. Please share this with someone who's into this kind of content, and please subscribe. Most people don't learn this kind of stuff, so if you do find it helpful, you're already ahead. Thank you, and let's get back into the video. So the third thing, global uncertainty. This is probably the most unpredictable part of the entire situation, okay? And right now, a big focus is on geopolitical tension, right? We got the war with Iran, especially in regions that affect energy supply. Because here's the reality: the Fed can't control interest rates, but they can't control what's going on overseas. They can't control global events. They can't control wars, supply shocks, or sudden spike in oil prices. But those things directly impact inflation. So imagine this scenario. Let's just say like the Fed cuts rates, and then suddenly oil prices spike even higher because of global conflict. Now what you got more spending from lower rates. You got higher energy costs. Inflation is rising again. That will put the Fed in a bad spot. It'll put them in a bad position. So instead of taking that risk, they're choosing to wait it out and see how this global situation is going to play out. And this is something the Fed has actually emphasized recently, all right? There's a lot of uncertainty right now going on. And when uncertainty is high, central banks tend to move slower, not faster. Because making a mistake in an uncertain environment can be very costly. And we pay the cost, the consumer, me and you. So holding rate steady gives them flexibility. It allows them to respond later with better information instead of just guessing, all right? Going forward, what does all of this mean going forward? Here's the big takeaway from all of this. The Fed is in full wait and see mode, okay? They're not committing to cutting rates right away, but they're also not saying rates will stay higher forever. Instead, they're watching the data. Specifically, they're looking at inflation reports, job market reports, consumer spending, energy prices, and to be honest with you, they're trying to figure out what's going to happen in Iran. And based on how everything evolves, that's what will determine the next move, in my opinion, okay? So what are the possible outcomes? You got a couple of different scenarios, right? All right, just to kind of give you an idea. Scenario one, inflation continues to cool down, the economy stabilizes. Probably not gonna happen. Then the Fed could start cutting rates later this year. Scenario two, inflation stays stubborn, energy prices rise again. Then rates could stay higher for longer. Scenario three, the economy slows down more than expected. Then the Fed might be forced to cut rates sooner. The key point is this: nothing is locked in. And that uncertainty is exactly why they don't make a move this time, all right? If you were expecting interest rate cuts right away, this might be a reality check for you. The economy is in a very unusual position right now. Inflation is lower, but not gone. Growth is slowing, but we haven't collapsed, all right? And global uncertainty is still high, and basically, because of that, the Fed is choosing to be patient over its actions, okay? They're waiting for a clear signal before making the next move. I can understand that. I can appreciate that. But that concludes the video. If you find this helpful, make sure to like, subscribe, drop a comment. And as always, thank you for tuning in to Evanomics, your #1 source for everything econ. I'll see you on the next video.